Okay, so you want to own a clearing and forwarding agency. A shipper needs cargo moved from one country to another. You handle the paperwork, book the carriers, clear customs, and collect a fee for making global trade actually function. Sounds like one of the most essential, recession-proof businesses in the world. International trade never really stops. But here's the strange part. In 2023 alone, roughly 88,000 trucking companies and 8,000 freight brokerages shut down in the United States. Not small, undercapitalized startups exclusively. Established firms with decades of operating history, sitting inside an industry that literally every physical product on Earth has to pass through at some point. And here's the part that should really give you pause. One digital freight brokerage raised over $1 billion from investors, including Jeff Bezos and Bill Gates, reached a valuation of $3.8 billion, and still shut down completely within 18 months of that peak valuation, closing its doors so abruptly that truckers who'd hauled loads for the company were left owed hundreds of thousands of dollars, with almost no notice. By the end of this video, you'll know exactly how a clearing and forwarding agency actually makes money, why the middleman position in global trade is far riskier than it looks, why even a billion-dollar company with legendary backers couldn't survive this industry, and what it actually takes to build a real, defensible agency business. The three sizes of this business. Clearing and forwarding businesses come in roughly three sizes, and the regulatory hurdles look deceptively small at every level. The smallest entry point is a licensed freight broker, someone who arranges transport between shippers and carriers without physically touching the cargo. Getting a Federal Motor Carrier Safety Administration license requires a surety bond of $75,000, though you typically only pay 2 to 5% of that as an annual premium, roughly $1,500 to $3,750 a year. That's a genuinely low barrier to entry, which is exactly why this tier is the most crowded and competitive. The middle tier is a licensed customs broker and freight forwarder, a firm that actually handles customs clearance alongside booking transport, requiring a customs broker license, an FMC ocean forwarder license running around $1,250 in application fees, and often ITA accreditation for air freight. The exam and application fees themselves are cheap, often under $500 combined. The real cost is everything around them: licensed staff, compliance systems, and enough working capital to survive a business where clients routinely pay on 30 to 60-day terms while your obligations to carriers and customs authorities often come due immediately. The top tier is a full international freight forwarding operation with multi-country coverage, warehousing, and dedicated logistics technology, the kind of firm that competes for large corporate shipping contracts. At this scale, licensing and compliance costs alone commonly run $20,000 to $50,000. Office and operational build-out adds hundreds of thousands more, and a genuinely competitive technology platform for tracking and client management can run into 6 or even 7 figures if built rather than licensed. Here's the detail that catches almost every new agency owner off guard. The licenses themselves are almost an afterthought cost. The real barrier to entry is trust. Shippers are handing you responsibility for cargo worth far more than your entire company is worth, and building the carrier relationships and client confidence to handle that responsibly takes years, not a licensing exam. Where the money actually goes. A clearing and forwarding agency typically earns money through a markup on carrier freight rates, a flat handling or documentation fee per shipment, and customs brokerage fees for clearance work. On paper, this looks like a clean, repeatable margin business. In practice, it's a business built on a timing mismatch that catches almost everyone eventually. Here's the trick. You often have to pay carriers, port authorities, and customs duties on your client's behalf before your client has paid you back. Meanwhile, your client, often a large importer or exporter with real negotiating leverage, is paying you on standard commercial terms of 30 to 60 days. You are, in effect, extending short-term trade credit to your customers as a hidden, unpriced part of every single shipment you handle, whether you intended to or not. This is exactly why the freight brokerage side of this business is famous for surviving its down cycles through radical cost flexibility rather than genuine resilience. As one industry analyst put it, freight brokerages manage revenue volatility by keeping fixed costs low and compensation heavily incentive-based, so that costs contract automatically when volume falls. That flexibility explains why hiring sprees and mass layoffs are common in this industry, and why outright company failures, while relatively rare in ordinary years, become genuinely common the moment freight volumes and rates both fall at once, which is precisely what happened starting in 2022. Here's the part that breaks people's brains the same way a rigged casino game breaks a gambler's brain. You don't control freight rates, which are set by global carrier capacity and demand. You don't control your client's payment timeline, and you're personally on the hook for carrier and customs payments regardless of whether your client pays you on time. A margin business that looks stable in a normal freight market can turn into a cash flow crisis within a single bad quarter, purely because the timing gap between what you owe and what you're owed suddenly stops closing. Why even a $3.8 billion company couldn't survive this? You'd think that with over $1 billion in venture funding and world-class technology, someone could finally build a freight brokerage immune to this industry's volatility. One company tried exactly that, and it's the most instructive case study in the entire sector. Founded in Seattle in 2015 by former Amazon executive Dan Lewis, Convoy set out to modernize what it saw as a fragmented, low-tech freight brokerage industry still largely run over phone calls and fax machines. The pitch worked spectacularly on investors. Convoy raised more than $1 billion total from a roster that included Jeff Bezos, Bill Gates, Reid Hoffman, and Mark Benioff, reaching a peak valuation of $3.8 billion in April 2022 after a $260 million funding round. Then the freight market turned. Starting in 2022, the industry entered what analysts came to call the Great Freight Recession. Falling freight rates, excess trucking capacity, and softening shipment volumes that hit digital freight brokerages especially hard, since their entire value proposition depended on high transaction volume to make their technology investment pay off. Convoy cut its staff from a peak of 1,500 employees down to around 500. In October 2023, after a 4-month search for a buyer came up empty, CEO Dan Lewis told remaining staff in a memo that today is your last day at the company. The shutdown was abrupt enough that some truckers who had hauled loads for Convoy in its final weeks were left owed significant sums. One small trucking company owner reported being owed nearly $160,000, with no severance offered to laid-off staff either. The lesson isn't that Convoy had bad technology or bad people. By most accounts, neither was true. It's that even a business with over $1 billion in capital, legendary investor backing, and a genuinely innovative approach to an old industry still couldn't out-engineer the fundamental economics of freight brokerage. Thin, market-set margins, high fixed technology costs, and a business model that depends entirely on transaction volume staying high. When volume and rates fell simultaneously, no amount of prior funding could buy Convoy enough time to wait out the cycle. How smaller agencies actually lose this money. Away from headline collapses like Convoy, 3 ordinary patterns explain most agency failures at the small and mid-sized level. Pattern 1. Underpricing the cash flow gap. New agencies competing for their first major clients often accept standard 30 to 60-day payment terms without pricing in the real cost of fronting carrier and customs payments during that window, then discover they need working capital far beyond what they budgeted just to keep operating while waiting to get paid. Pattern 2. Client concentration. An agency that builds its business around 1 or 2 large shippers looks efficient and profitable right up until that client switches providers, brings logistics in-house, or hits its own financial trouble, at which point a huge share of revenue disappears at once, with no time to replace it. Pattern 3. Getting caught on the wrong side of a rate cycle. Agencies that locked in carrier capacity commitments or expanded staff aggressively during the freight boom of 2021, betting that elevated volumes and rates would continue, were often the ones that couldn't cut costs fast enough once the market corrected starting in 2022. Precisely the pattern behind the wave of tens of thousands of freight company closures that followed. What you actually walk away with. Scenario 1. A small independent customs brokerage and freight forwarding operation, handling a modest but diversified client base of importers and exporters. Realistic annual revenue in the $500,000 to $1.5 million range on brokerage fees and freight markups, with net margins commonly in the 10 to 15% range once staffing, compliance, and working capital costs are covered. Call it $50,000 to $225,000 in real annual profit, with meaningful exposure to any single client's payment reliability. Scenario 2. A mid-size forwarder with genuine multi-country capability and a diversified corporate client base of a dozen or more active accounts. At $3 to $8 million in annual revenue, better negotiating leverage with carriers and lower relative overhead per shipment can push margins toward the higher end of that range, putting real profit in the range of $400,000 to $1,200,000 a year, the point where this becomes a genuinely defensible business, less exposed to the single client and single cycle risks that sink smaller operators. So if you're chasing this business, remember the real rule of this industry. You're not just moving paperwork and booking carriers. You're quietly extending credit on every shipment you touch, in a business where rates and volume can both collapse at once with no warning. A lesson that even $1 billion in backing from Jeff Bezos and Bill Gates couldn't buy Convoy enough time to survive.